Welcome. In this video, Xcn Liquidity has been received. Can there be an increase? We will analyze this. Don't forget to subscribe, like, and please watch the end to understand.
First, for the price to enter an uptrend, one of the most fundamental structures accepted in technical analysis, higher lows and higher highs, must be taken into account. Because when the price of an asset, whether cryptocurrency, stocks, or commodities, reflects that market participants' willingness to buy is strengthening and selling pressure is weakening, the price first forms a low that is higher than the previous one. This indicates that buyers don't want to leave the market at lower levels and that sellers are struggling to push the price down further. Then, if the price moves above the previous high to form a higher high, one of the strongest signals for an uptrend has been given. This structure shows us that both the low levels have moved upward, meaning support zones are stepping up, and the peak levels are rising, meaning buyers' appetite remains strong. The effort of the price to create this structure actually reflects the psychological balance in the market. By human nature, when the price recovers from lows, most investors are not yet confident, as past selling pressures remain in mind. However, if each recovery finds support at a higher level than the previous one, these doubts decrease and buyers begin to act more boldly. This psychological transformation becomes visible on charts as higher lows. The price forming a higher high is not just a technical pattern, but also fresh evidence of renewed confidence in the market's future. Because breaking through the previous peak shows that buyers no longer give in to selling pressure at those levels, but instead act with even greater buying enthusiasm. As this continues, a chain reaction begins in the market. Higher lows start to attract new investors, because this clearly visible structure on the chart is considered a reliable signal by many technical analysts. Then, with higher highs, the trend strength is further reinforced. For example, if the price first rises from 100 units to 120 units, then finds a low around 110 units, and then climbs toward 130 units, here the first low is 100, the first high is 120, the second low is 110, and the second high is 130. This sequence should be thought of as a staircase moving one step higher each time. Each step represents new strength and the continuation of the trend. During the price's attempt to form higher lows and highs, certain challenges can arise. Sometimes the price attempts to rise but faces strong selling at the top and pulls back. The critical point here is that the pullback must not fall below the previous low. If the price manages to find support at a level higher than the previous low, this signals that the bullish scenario remains intact. This is why many investors pay close attention to not only whether the price breaks through the peak, but also to where the lows form. Because higher lows are a sign that the trend is progressing in a healthy manner. In addition, higher lows and high structures not only confirm the start of a trend in technical analysis, but also its continuation. Many strong bull markets initially begin with small rises, limited low and high movements, but over time, as buyers increase, these movements turn into larger waves. A small-scale higher low may be the first spark of a major rally in the future. Therefore, investors should not ignore even these small signals. Moreover, the formation of higher lows and highs forms the foundation of trend-following strategies in the market, because trend-following investors prefer to wait for confirmation of the trend instead of entering early. When a higher low and high structure appears, the probability of the price going higher is now stronger than the probability of it falling lower. Thus, investors join the market while minimizing their risk. This is also important in long-term portfolio management because as long as the trend continues, the investor continues to profit from price movements. On the other hand, one point investors should pay attention to during the formation of these structures is trading volume. If a higher high comes with increased trading volume, this means the rise is based on a stronger foundation, because it is not just the price movement, but also the amount of money flowing into the market that supports the increase. If the price forms a higher high, but volume remains low, the likelihood that this rise is just a short-term bull trap increases. However, if both the lows are rising and the highs are breaking with volume support, it is thought that the trend will be longer-term and more sustainable. In conclusion, the price attempting to form higher lows and higher highs is one of the most important building blocks for the start of an uptrend in the market, because this formation is not just a simple move seen on the chart, but also the result of the psychological battle between buyers and sellers. Rising lows show that sellers are losing strength and that buyers have managed to push the market to accept higher levels. Rising highs prove that buyers are still strong and determined to push the price upward. As long as this structure continues in a healthy way, the uptrend stays alive, and the market reaches increasingly higher levels. But we can't base our analysis on this alone, so let's take a look at other metrics as well. Stay tuned.
When an upward crossover occurs in the MACD indicator, it is considered a very important signal in technical analysis because it indicates a shift in momentum in the current market direction. Specifically, when the MACD line crosses the signal line from below to above, it signals to investors that buyers are gaining strength and that the price may be preparing for a stronger upward move in the near term. This structure shows that the supply-demand balance in the market is shifting in favor of buyers and that selling pressure is decreasing. One of the strongest aspects of technical analysis is its ability to predict potential market direction through visual signals like this, and an upward crossover in the MACD provides a very strong clue to investors in this regard. For the price to start an upward move, short-term momentum typically needs to catch up with the long-term trend. This is where the MACD comes into play because it is calculated based on the difference between the short-term and long-term exponential moving averages. The movements of this difference relative to the zero line and the signal line indicate the direction of momentum. An upward crossover shows that short-term momentum has begun to surpass the long-term trend, meaning buyers are becoming more visibly dominant in the market. Increased trading volume during this time supports the upward momentum, and the subsequent candle closings after the crossover are very important for confirming the bullish move. In such a scenario, the price beginning an upward move also reflects a psychological shift. Investors do not ignore these types of crossovers on technical indicators, and when this structure is noticed, more investors tend to move to the buying side. This creates a chain effect, pushing the price higher. In other words, an upward crossover in the MACD is not only a mathematical calculation, but also a structure that triggers investor psychology. Some investors use the signal as an immediate buying opportunity while others wait for stronger confirmation. However, overall market sentiment begins to shift toward bullish expectations. This expectation further strengthens the upward movement of the price. The effectiveness of these crossovers is also influenced by trend direction. If the market is already in an uptrend, the MACD upward crossover is interpreted as a strong signal that the trend can continue. The stronger the trend, the more powerful the price movement following the crossover. Additionally, if the price has bounced from support levels or reacted upward from significant Fibonacci levels, the MACD upward crossover acts almost as confirmation of this movement. In such cases, the likelihood of the price starting an upward move is much higher because both technical indicators and the price structure provide consistent signals. The price moving upward usually manifests as rapid and sharp gains. For markets that have previously gone through consolidation periods, such a crossover indicates a breakout from the consolidation and the entry of buyers. At this point, the price gaining strong upward momentum often attracts short-term traders. Traders seeking quick profits see such crossovers as immediate opportunities in open long positions. This increases demand and contributes to pushing the price higher. Therefore, an upward MACD crossover serves as a buy signal for both medium to long-term investors and short-term speculators. Additionally, the MACD histogram is important during the process of the price starting an upward move. When the histogram moves from the negative zone towards zero and then into the positive zone, it indicates increasing momentum. When this upward movement is supported by the price, it signals that the bullish move may be more sustainable. The gradual growth of the histogram bars shows that buyers are gaining strength and that the upward move can continue. At this point, investors should pay attention to whether the price is entered overbought zones despite the upward move. If the rise is very sharp and indicators show overbought conditions, short-term corrections may occur. However, these corrections do not mean the overall uptrend is broken, rather they can be part of a healthier upward process. After the crossover, the price beginning an upward move can sometimes create a domino effect. Many algorithmic systems and automated trading bots enter buying positions following this signal. Since a large portion of today's markets operates through such automation, post-crossover buying can accelerate. When human investors notice this movement, the price has often already started rising, triggering FOMO. New buyers entering the market due to FOMO further strengthen the upward move. This chain effect can cause the price to rise faster than expected. Investors should also consider the MACD crossover in conjunction with the overall price structure rather than in isolation. If the price is near significant resistance levels, the upward crossover may occur, but the price could struggle at those levels. However, if resistance is broken, the upward move can accelerate further. Therefore, investors should not base their decisions solely on the crossover, but also consider support resistance zones and volume structures. This ensures that the price's upward move progresses on a more solid foundation. In summary, when an upward crossover occurs in the MACD indicator, the price beginning an upward move shows that market dynamics have shifted in favor of buyers. This structure is a strong signal both technically and psychologically. Buyers gaining strength, increasing momentum, supportive histogram signals, favorable trend direction, and volume confirming the move all create the conditions for a stronger upward move. As a result, the market follows the signal provided by the upward crossover, pushing the price to higher levels and offering profitable opportunities for investors.
When the price reaches the area you've marked, dips downward, leaving a wick, and then moves back upward, this is considered a very important signal in technical analysis. Such formations are particularly noteworthy because they clearly reflect the balance of power between buyers and sellers in the market. A wick indicates that the price attempted to drop below a certain level, but a strong group of buyers stepped in, causing the price to recover and move upward again. If this movement occurs at a clear support level, a Fibonacci level, or a previously strong demand zone, the likelihood of a continued upward movement becomes significantly stronger. When this type of candlestick pattern appears in the market, the prevailing interpretation is that sellers tried to push the price down, but buyers responded strongly at that level, pushing the price back up. This provides a strong clue that buyers are gaining strength while sellers are struggling at this level. The longer the wick, the more it emphasizes that sellers' efforts were unsuccessful. Despite being pushed lower, the price could not stay down and was instead pulled up by strong buying orders. This is often read as a sign that the upward movement may continue. Wicks are particularly valuable for understanding market psychology. While the candle body shows the net movement between the opening and closing prices, the wick illustrates the battle that took place and its outcome. In your marked area, where the price dipped, left a wick, and then recovered, it signals significant support buying. Buyers are strongly present at that level, preventing the price from dropping further. Such scenarios boost investor confidence and create the conditions for a bullish expectation to form. Moreover, the price recovering from that level after leaving a wick is not just a short-term reaction. It can often mark the beginning of a larger trend. Market participants see this wick formation and interpret it as the price does not want to go below this level, which encourages buyers to act more aggressively. Increased buying activity pushes the price higher. This is why wicks are often regarded as leading signals in technical analysis. The price leaving a wick and then moving upward can also be part of a liquidity gathering process. Large market participants often push the price below areas with stop orders to trigger panic selling by smaller investors. These larger investors then collect liquidity from these sales and immediately push the price upward. From the outside, this appears as a wick. Essentially, the wick may indicate that large players are gathering liquidity and setting the stage for a bullish move. This helps explain why the formation you've marked is often considered a bullish signal. In such cases, investors generally think if the price were meant to break downward, it would have stayed below the wick and closed lower. Instead, the price recovered upward, indicating that the market is leaning bullish. This is interpreted as a reliable signal in technical analysis. Sometimes these wicks are also called pin bars or needle candles and are considered trend reversal signals. Another important factor is the time frame in which the wick forms. Wicks seen on daily or weekly charts generate much stronger signals because they reflect the collective psychology of a broader group of investors. Wicks on shorter time frames are meaningful as well, but tend to indicate more short-term reactions. If you observed such a movement in the area you've marked, especially coinciding with a support level, the upward potential can be considered strong. Additionally, these movements boost investor confidence, and upward closes following a wick are often accompanied by increased volume. This shows that buyers are actively participating not just through price movement but also in trading volume, providing a firmer foundation for the bullish expectation. If a strong wick has formed in that area, the likelihood of the price continuing upward from there is very reasonable. From another perspective, these wicks can confirm the continuation of an existing trend as well as signal reversals. If the price temporarily dips within an overall uptrend and then leaves a wick and recovers, it generally indicates that the trend is progressing healthily and that buyers are not relinquishing control. Therefore, this pattern not only signals a potential reversal, but also indicates that the trend remains strong. In summary, when the price dips in the area you've marked, leaves a wick, and then moves back upward, it demonstrates strong buyer reaction, sellers struggling, and a very high probability that the price will continue upward. This formation is widely trusted in technical analysis. It indicates that buyers have taken control and that the price is likely to maintain its upward trajectory. The message from wicks is usually the price attempted to go lower, but the strength is with buyers. It couldn't stay down, and now the direction may be upward. This is why, as you mentioned, the likelihood of the price moving upward after this movement is very high and is considered a positive technical signal.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.